So let's continue with chapter 3 and cover the cost of capital. Before we go into these maths and equity and debt, let's just think about what we are trying to study here. When you invest in a certain project, you need to finance that project. You need to get cash and invest it. Where is that cash going to come from? If you are going to acquire a company, if you are going to invest in a project, if you are going to buy a stock, anything that you're going to be investing in, where are you going to get the cash to pay for it? Well, some would say that's quite easy. We'll borrow. So by borrowing debt, we might take a loan from a bank and we will use that money to finance that project, to acquire that company, to buy that stock. Okay, that's completely fine. But that debt is not free of charge. You have to pay interest on that debt. Let's assume you have to pay a 5% interest on it. So that project, whatever it is, a company you're acquiring, stock you're investing in, that project should get you at least 5% return, right? In order for you to cover the cost of 5%. You used the money you borrowed, the debt, to invest in that project. So the interest on that debt, which you have to pay a bank, is your cost. And that company should cover the cost at the very bare minimum. It should cover the cost. If that project or that investment or that stock is expected to give you 4% return, for example, on a money that's costing you 5% to the bank, so obviously this project, you should not be taking it. You should not be investing in this company because the return is less than the cost. So this is what we call the cost of debt. Any project which is supposed to be invested in should cover its cost at the very bare minimum. And this is what we call at the very base. Of course, the cost of debt is a bit more expensive than that, but at the very basis of it, it's this is the idea: cost of debt. Cover the interest that we're paying on our debts, whether it's a loan or a bond. If you are the management of a company, or you are an investor yourself, and you're not actually using debt, you're using capital, you're using equity to finance that project, that's also completely fine. But that equity has a certain attachment to it. There are strings attached to that equity. Whoever gave you that equity, that capital, is expecting some returns from you. So that equity, let's assume the shareholders are expecting a 10% return on their investment. So whatever project that you are going to go into, it has to return at least 10% in order to meet the shareholders' expectations. If that project is only getting you 8% return, that means you have failed your shareholders. Your shareholders have invested in your company. They are expecting a 10% return. We call that expected return. And you took that money and you invested it in a project that only generated 8% for them. You have failed your shareholders. So this project should not be taken. We understood from the previous session that the capital of the company can be made up of both equity and debt. That's the capital of the company. So if you have a certain project that you are investing in. And that can be, again, a company you are acquiring, a stock you're investing in. If there is a certain project that you are investing in and you are financing that project by borrowing and by using your shareholders' equity, then your cost of capital is both the cost of debt and the cost of equity. Assuming from the previous example that the cost of debt is 5% and the cost of equity, of course, the cost of debt, this is the interest, we're still simplifying things a lot. So you have to cover the interest, and the cost of equity, which is the expected return of your shareholders, which is 10%. Let me just follow the standards. So your shareholders are expecting a 10% return. This tells me that the project should cover both the cost of debt and the cost of equity. Now keep in mind, you are not going to cover all of the 10% or all of the 5% because you're not going to use all of the debt. I mean, if you're going to use all of the debt to finance that project, then it has to bring you at least a 5% return. If you're going to use all of equity, purely equity financed, then it has to return at 10%. But if you're combining both equity and debt, how much equity are you putting? If you put in half of the capital in equity and then half of the capital from debt, then technically your cost of equity is half of 10%. That's 5%. And it's half of 5% for debt, so that's 2.5%. Because you are using combination of both equity and debt. So if 50-50, well, then you have to take half of the cost of equity and half of the cost of debt. So this project should bring you at least a 7.5% return in order to be acceptable to the investors and in order to cover the cost of debt. So now what we did here is we took the weighting of the equity. In this case, it was half of the capital, and we took the weighting of debt. Again, it was half of the capital. We took the weighting of the equity and the weighting of the debt, and we got 7.5%. We call this the weighted average. And the 7.5% is your cost of capital. That means this project, whatever company or project that you're going to be investing in, needs to cover this cost of capital of 7.5%, which we arrived at by taking the weighting of our equity and debt. So the way we write this is the cost of debt, in this case, was 5%, but we only took half of the 5%, so 50% of it. And we took the cost of equity. The cost of equity in this case was 10%, the expected return from our investors, but we also took only half of it because this project was financed by both equity and debt. So this is written as follows. Cost of equity, cost in finance is signified with letter K, times the weighting of the equity plus the cost of debt times the weighting of debt. So this gives you your cost of capital, but it gives you your weighted average because you have given the equity and the debt their proper weightings. Yes. Yeah, usually we go for the historical side. How? Because this debt, this project that we're going to finance, we are going to use existing debt, unless we are going to make a new borrowing. If we are going to be making a new borrowing to finance this project, then we have to use the cost of that borrowing. So it's not historical or projected. For the equity side, if it is, we using existing equity, then we are going to use existing cost of equity. If we are going to make a new issue of shares, then we have to use the cost of this new issue of shares. So in a very simple manner, what are you using? Existing equity and debt? You use the existing cost of equity and debt. Are you going to make a new issue of shares or a new issue of bonds? Then you have to use the cost of this new issue of shares and the cost of this new issue of bonds. This is, in a very simplified way, is the weighted average cost of capital. And every project you are going to finance has to bring you this 7.5%. It's your cost. So this is what this formula is telling you about. The cost of equity times the weight of equity. So this is it. And this is the weight of debt. And the cost of debt here, the percentage, yield here is on the bond, assuming it's a bond. So this is the cost of debt. But what is this thing here? Why did we multiply the cost of debt by 1 minus T? T is tax. It's because if you are borrowing 5%, your debt is costing you 5%. Remember, when a company makes its financials, you have the earnings before interest and tax, and then you deduct interest. And then this gives you the earnings after interest, and then you deduct tax, and then you get the earnings after tax. So interest is something that is deductible. That means you can save tax on it. So if I am paying on a loan $100,000 and the interest on it is 5%, some would say, well, that means you are going to be paying a $5,000 interest on it. No, you are going to deduct it because there is some tax that you can save. Assuming that your tax is 10%, technically, what this loan is costing you is $5,000, 1 minus tax, which tells you it's $5,000 times 90%, which is $4,500. So you have saved $500 in tax. So your actual cost of this debt is $4,500, which is 4.5%. That's why whenever we are calculating the cost of debt, if this is a country that has tax, we have to include the effect of tax. Tax is there's a savings on debt. So we've noticed here, if we have taken 5% as our cost of debt, we would have been wrong. We should have taken instead, as a cost of debt, instead of 5%, we should have taken 4.5% instead of 5%. And we calculated by doing the 5% times 1 minus tax. And then we take the weighting. This is the weighted average cost of capital. I just need to add one more thing for you here. So usually a company issues debt, bond, it issues shares, ordinary shares. So this is the cost of the bonds and its weighting, and the cost of the shares, which is the expected return and its weighting. But also, a company can issue preference shares, and preference shares carry a fixed dividend payment. So if you're given a question in the exam where there is a preference share there, you just have to add the cost of the preference share times its weighting of the preference share, if there is a preference share issue. Here is a quick example of a company called Cadence. They have a 300 million market capitalization. Market capitalization is the value of equity. And a 200 million market value of debt. The post-tax cost of debt is 3%. And the cost of equity, expected return, is 7%. The tax rate is 40%. What is the weighted average cost of Cadence? I am going to give you 2 minutes to answer this quickly. Let's calculate it quickly. The weighted average cost of capital equals to the cost of debt into 1 minus tax times the weighting of debt plus the cost of equity times the weighting of equity. I don't think they said anything here about preference shares. So there are no preference shares. So we'll just leave it at equity and debt. What is the cost of debt? Here it tells you that the post-tax cost of debt is 3%. So they've already included the effect of tax. This line here, the tax rate is 40%, is useless. You don't need to consider the 40% anymore, because this 3% already has absorbed the effect of tax. So this tells you that the cost of debt is 40% times, what is the weight of debt? We don't know yet. Okay. Plus the cost of equity, but this is very simple. They give it to you 7% times the weight of equity. We don't know that. Oh, sorry, 3%. You're right. Thank you for correcting me. So the cost of debt is 3% and the cost of equity is 7%. So what is the weight? We need to know the weight of debt and the weight of equity. We know that the company has 300 million in equity and 200 million in debt. So both is 500 million. So the weight of equity equals to the 300 million, how much equity they have, over the total capital, which is 500. And this should give us 300 divided by 500. So that's 60%. The weight of debt, so they have 200 million debt out of 500 million capital. So that should give us a 40%. So 60% of their capital is equity, 40% of their capital is debt. So the weight of debt is 40%. And the weight of equity is 60%. So 3% by 40%. That's 1.2%. Plus 7% by 60%. That's 4.2%. So we add them together, 5.4%. So the answer is D. Good. Let's continue. So we looked at the cost of debt, and we said it is the interest paid net of tax relief. The yield on the debt, usually the gross redemption yield, considering the effect of tax on it. We've already covered this. Let's move on to cost of debt and to the pricing of a bond. A bond is made up of multiple cash flows in the future. So for you to arrive at a price of a bond, you just have to add the present value of these future cash flows. Discounted. It's very easy. We covered this before. The value of a bond, the price of it, the fair price of that bond, is you add the coupons throughout the years, and at the final year, you add the redemption value, which by default should be £100 unless otherwise indicated by CISI. But every year, you should discount that cash flow coming in. What discount rate should we use for bonds? We use the yield to maturity or the gross redemption yield. In the case of a 3-year bond, you're going to get a coupon in the first year, a coupon in the second year, and in the third year, you're going to have both a coupon and the redemption value. So here's a quick question. Future PLC has a 7% bond. 7% bond means 7% coupon on a bond. In issue, again, 100 nominal value. If this wasn't given to you in the exam, just assume it, 100. With 3 years to maturity, comparable bonds in the market are yielding 5%. So this is the yield to maturity. And you can assume that this is the required, well, it just told you that in the question. In the exam, they won't tell you that. In the exam, they'll just tell you that they're yielding 5%. This will not be given to you in the exam. This is something that you should assume. What is the present value of the bond per 100 nominal? Well, the value of the bond is equal to the discounted value of the cash flows. So in the first year, since it's 7% bond on a nominal of 100, you are going to be earning $7 in coupon. In the second year, you're going to be earning $7 in coupon. In the third year, you're going to be earning $7 in coupon plus $100 in nominal. But we have to discount these, right? By 1 plus the rate. What's the rate? 5%. In the first year to the power 1, we don't need to write it, just to be clear. In the second year, to the power 2. And in the third year, to the power 3. So this should give us, quickly, 7 divided by 1.05. So in the first year, 6.67 plus. In the second year, 1.05 to the power 2. The value of that cash inflow is 6.35. In the third year, 107 divided by 1.05 divided by 3. 92.43. So adding all of these together will give you the current value or the fair price for the bond, 6.35 plus 92.43. So this is 105.45. This is the present value of the bond, which should be the fair price for it. Now that's the cost of debt. Let's get to the cost of equity. The cost of equity is the expected return of a certain investment. So, if you have two companies, two shares, A and B, and the beta is the measure of risk. In chapter 1, we studied standard deviation. And we said standard deviation is how volatile, which is also a measure of risk, how volatile a company is. We looked at the average return of that stock, and we calculated how much it moves away from that average. If a stock moves away very much from the average, a lot going up and a lot going down, that's a very volatile stock. So the standard deviation is very high. And because the standard deviation is very high, we expect a higher return, because higher risk, higher return. The beta is comparing the stock to the market, not to its own average. And the beta can be 1. If a stock has a beta of 1, it means that it moves in line with the market. Whatever return the market is getting, that stock will give you the same return. If a stock has a beta of 1.5, this is a more sensitive and more volatile stock because it's moving faster than the market. If the market goes up 1%, this stock will go up 1.5%. But if the market goes down 1%, this stock will go down 1.5%. So a beta of 1.5 tells you that this stock is a higher risk. And therefore, we should be expecting a higher return from it. And conversely, if a stock has a beta of 0.7, this is a slower stock. It has less volatility. So it's a lower risk. And therefore, the expected return on this investment will be lower than the market. The market can be the benchmark, the index. Usually it's going to be sort of the index. So let's assume that there are two stocks. Stock A has a beta of 1, so it moves in line with the market, and stock B has a beta of 1.5. So stock B is a higher risk investment. And the market currently, you are getting a return if you invest in the market like in a broad index like the S&P 500. The return of the market is, let's say, 7%. So if I know that the return of the market is 7%, can I calculate the expected return on these two stocks? Well, yeah. Let's start with stock A. Stock A has a beta of 1. This tells you that it moves with the market. If the market is getting me 7%, then stock A should get me 7% return. Because it has a beta of 1, it moves in line with the market at the same rate. Stock B, however, has a high beta, 1.5. So I should be expecting a higher return than 7% because I am taking more risk. How much higher return than 7%? This is where the CAPM formula comes in. The capital asset pricing model, which was invented by Mr. William Sharpe and Mr. Jack Trainer, of course, of the Sharpe ratio and the Trainer ratio, but we won't get into them now. They said the higher the beta, the higher the expected return. And their formula tells you that in order for you to calculate the expected return, you're going to need the beta, which we already have. You're going to need the return on the market, which we already have. And you're going to need the risk-free rate or the risk-free return, which is basically an investment which gives you no risk but gets you some sort of return. And in this exam, you should automatically assume that the risk-free return is the one given by government bonds, especially treasury bills. Government bonds, which are a completely safe investment, particularly short-term ones, very safe investment. Let's say these are yielding 2%. So if I have a beta given to me and the return of the market, the index, the broad market, 7%, and treasury bills, which are a risk-free investment, getting me 2%, can I understand or get what the expected return on stock B is? Yes. And the formula for it is the expected return of an investment is the risk-free return plus the return on the market of the market minus the risk-free again into beta, which is written with the Greek letter B. Now, some people would put the beta first, but what's important is that you have to complete this calculation first before you add it to the risk-free. So for stock B, the expected return, risk-free is 2%, plus the return of the market is 7%, minus the risk-free again, 2%, into the beta, which is 1.5. So that's 2% plus 7 minus 2, 5% times 1.5, that's 7.5. if I'm not mistaken, 1.5 times 7, sorry, times 5, that's 7.5. So this tells me that the expected return on stock B is 9.5%, which is higher than 7. So why is it higher than 7? Because it has a higher beta. This is the expected return. This is the cost of equity of stock B, the expected returns of the shareholders. Now, we said that for stock A, since it has a beta of 1, it follows the market. Whatever the market return is the return of stock A, 7%. Let's see if CAPM is going to give it to us. We didn't need to calculate it because we just assumed it using a beta of 1. But let's apply for stock A. Let's see what CAPM will tell us. Again, it's the risk-free return, 2%, plus the return on the market, 7%, minus the risk-free return again, 2%, times, what is the beta of A? It's 1. This will give us 2%, plus 7 minus 2, that's 5%, times 1, that's 5%. So the expected return on stock A is 7%, which is true. We didn't need to calculate it because we already know the beta of 1, so the return on stock A is 7%, equal to the market. By the way, this right here in the bracket, the return on the market minus the risk-free return, is what we call the market risk premium. We've seen in the exam questions where CISI does not give you the return on the market. They just tell you that the market risk premium is 5%. So they have already calculated this for you. They don't give you the 7%. They actually tell you it's 5%. Remember, if you get the market risk premium, they have already deducted the risk-free. No need to deduct it again. If you do, you'll get the wrong expected return, which might be in one of the choices because CISI is going to expect you to make that mistake. They're going to expect you that even when you're given the market risk premium, which is already the result of this bracket, some student might actually, after getting the 5%, they might deduct again minus 2, and that's wrong. So the cost of equity of stock A is 7%, and the cost of equity of stock B is 9.5%. In order to calculate CAPM and the cost of equity, the expected return, we need the risk-free rate, yield to maturity on a 10-year or a 12-year gilt. Sometimes you'll get it as a treasury bills. More likely, if you are given this or this, it's more likely on the short term. What this is telling is usually government bonds. We've seen both in the exam. Market risk premium, which is the difference between the expected return on a well-diversified portfolio, the return on the market, and the risk-free rate, minus the risk-free rate. The beta is the risk, measure of market risk, calculated based on historical data. So just a quick reminder, standard deviation is a calculation of risk compared to yourself as a stock, to your own average. Beta is a calculation of risk compared to the market. Present PLC shares have a beta of 0.7 compared to the UK equity market. If the UK equity market returns average 7% over the last 20 years and 15-year gilt yields are 2%, what is the cost of presence? What is the cost of presence cost of equity? What is the presence cost of equity? So the expected return, which is the cost of equity, equals to the risk-free rate plus the return of the market minus the risk-free rate times the beta. So the risk-free rate, gilt are just like I think we covered in chapter 1, these are government bonds, UK government bonds. So they're returning 2%. And the UK market, they forgot the word market, has averaged 7%. So that's the return of the market, minus the risk-free again, 2%, into the beta of the stock, 0.75. Always remember to complete this first before you add it to the 2%. I keep saying it because I've seen lots of students doing that mistake. So that's 5% into 0.75. So that's 2% plus, I think this should be 5 times 0.75, so 3.75. So this will give you 5.75 or 75, which is C. This is the cost of equity of present. So now that we know how to calculate the cost of debt and we know how to calculate the cost of equity, let's take a final question here. Let's calculate this quickly. I'm going to give you 2 minutes to calculate it. ABC Incorporated has debt in issue of market value of 55 million. The coupon on the debt is 5% and the tax rate is 40%. The debt trades at par. Just to tell you quickly, when a certain bond trades at par, the coupon rate will be very similar to the yield to maturity. We covered this in chapter 1 when we said when your cost and your return are the same, then the present value of the bond will be the nominal. So when the present value of the bond is the nominal, that means the coupon and the yield to maturity are going to be the same. So the coupon of the debt is 5%. This means the yield to maturity is also going to be 5%. This is not always the case. Keep in mind for the exam. If the debt is trading above or below par, which is nominal, the yield to maturity will be different than the coupon. They also have equity of 35 million and 7% preference shares in issue of the value of 10 million. If ABC's cost of equity is 8%, so they've already given it to you, no need for you to calculate the expected return, and the preference stocks trade at par. So again, the yield on the preference stock is equals to the dividend distributed. What's ABC's cost of capital? You've got 2 minutes. Okay. Let's solve it together. The weighted average cost of capital equals to the cost of debt accounted for the tax savings, tax relief, times the weight of debt plus the cost of equity times the weight of that equity, which is the expected return. Cost of equity is the expected return. And in here we have preference shares. So we just have to put the cost of preference shares times the weight of preference shares. So we start with the cost of debt. So we said the cost of debt is the yield to maturity, which in this case is 5% because the coupon, because the debt trades at par. So 5% times 1 minus the tax, which is 40%. So this gives you 5% times 0.6, which should give you 3%. Right? So that's the cost of debt times the weight of debt. We don't know that yet. We'll calculate it in a bit. Plus the cost of equity, 8%. We don't know the weight of equity yet. Plus the cost of preference shares. Since the preference shares are traded at par, which is the case in this level of qualification, the preference shares will be traded at par. So you just assume the dividend that they distribute. So that's the 7% times the weight of the preference shares, which we don't know yet. So let's look at the weightings. What's the total capital? Total value of this company, of the capital. So it's the 55 million, the value of debt, 35 million, the value of equity, and 10 million the value of preference shares. So 55 plus 35 plus 10, that's going to give you 100 million. That's the total. Now, debt is 55 of that. So which tells you that debt is 55%. So that's the weighting of debt. Equity is 35 million out of 100 million. So that's 35%. And preference shares are 10 million out of 100 million. So they are 10%. So doing this calculation quickly. 3 times 55%. So that's 1.65%. Plus 8 times 35%. So that's 2.8%. Plus 0.7%. So the weighted average cost of capital is 0.7, 5.15%. So the answer is A.